When most people think about making a mistake on their tax return, it often involves fear about checking off the wrong box or missing key data that might cause a CRA to audit them later on. But according to experts, the costliest mistakes Canadians make on their tax return is missing out on deductions and whether they need to even file a tax return in the first place or not. I want you to maximize your tax savings and avoid these common errors that Canadians make on their tax returns. Here are my top costliest mistakes on tax returns and how you can avoid them. Filing a tax return by yourself, especially if you're unfamiliar with the process, can seem complicated. So it's not surprising that oftentimes taxpayers make mistakes on the tax returns. Sometimes that mistake can be paying more in taxes than you should. Other times, it can mean you've claimed benefits that you weren't entitled to and have to pay them back, plus penalties, plus interest. To help you get your tax return right the first time around, this is why I've made this list of common tax errors that Canadians make when filing taxes. But what if you've already made one of these mistakes and want to know how do you fix them after the fact? Don't worry, because I'm also going to talk about how you can fix mistakes on tax returns that you've already filed. Mistake number 1, forgetting allowable deductions or credits. It's hard to know which income tax deductions and credits you qualify for year to year, especially when the government keeps tinkering with the tax returns and continues to make changes every year. It can be hard to keep up when the government is adding new tax breaks, getting rid of old ones, combining other ones, and doing this, that, and the other thing. But if you don't claim all the deductions and tax credits you're eligible for, that means you end up paying more tax than you should. This is obviously something you want to avoid. Here are some frequently overlooked tax credits and deductions you should look into when you file your 2020 tax return. A non-refundable tax credit for interest you paid on your student loans, a tax deduction for union or professional dues, a $5,000 non-refundable home buyer's credit for those that bought a qualifying home in the past year and have not lived in a home either owned by them or their spouse within the last 4 years, paying out of pocket for eligible medical expenses not covered by your work plan, missed donation receipts that oftentimes end up in your spam or junk folder in your emails, or that get lost in the mail on their way to you. And due to COVID-19, you may have been working from home and using your personal living space as your workspace. If you meet the eligibility criteria, you can claim a temporary flat rate method for claiming home office expenses. This is only good for the 2020 taxation year. The value of this deduction is $400 per individual if you worked at least 200 days from home. Mistake number 2, claiming ineligible expenses. On the flip side of missing tax breaks is claiming deductions and tax credits that either don't exist or that you're not eligible for. According to the CRA, one of the most classic examples of claiming deductions that you're not eligible for is related to moving expenses. Here's what you can claim for moving expenses. Taxpayers who move at least 40 kilometers closer to a new place of work or to study full-time at a post-secondary program can deduct a variety of moving costs, including transportation and storage, travel expenses, utility hookups, and disconnections, and fees for canceling a lease. But some taxpayers end up pushing their luck by trying to write off ineligible moving expenses, such as household repairs or costs for staging your home for a showing, or trying to claim expenses related to having your mail forwarded to your new address. Similarly, some students try and claim the student loan tax credit on interest they paid on personal loans, student lines of credit, or even foreign loans. These forms of borrowing are not eligible for the student loan tax credit. Mistake number 3, getting rid of slips and receipts. With online tax filing so common, taxpayers don't need to submit receipts or slips along with their electronic tax return. However, some people fail to keep that paperwork handy. Failing to keep that paperwork can be a problem, as the CRA can and oftentimes does request to see receipts for things like childcare expenses, donation receipts, medical expenses, or any other expenses that you've claimed. These type of requests is separate from an audit, which is less likely but can still happen. Individuals are required to keep at least 7 years worth of records related to their tax returns, and the CRA will only accept receipts, not invoices that include the date of payment. If you cannot provide the documents requested by the CRA, your benefits and tax credits can be denied, and then you may end up owing the CRA for these claims. Mistake number 4, neglecting to transfer unused tax credits to other family members. Individuals can transfer some of their tax credits to a spouse if they don't have enough income or tax owing to make full use of these tax credits. In some cases, such as a tuition tax credit, $5,000 can also be transferred to a parent or a grandparent if they're unused. For example, let's say you're a full-time student at an eligible education institution. You can claim a non-refundable tax credit equal to 15% to the tuition you paid. You can only use a portion of your tax credit to reduce your taxes owing to 0. At that point, any amount that's unused for this tax credit can then be transferred to a spouse, a parent, or even a grandparent. This can then lead to even greater tax savings, especially if the individual you are transferring the tax credit to is in a higher tax bracket. Mistake number 5, missing the tax deadline. Because of COVID-19, the 2019 tax filing deadline was extended in 2020. However, for the 2020 taxation year, the current deadline of April 30th seems to be on track. So that means for the 2020 taxation year, your deadline for employed individuals is April 30th, 2021. And for self-employed Canadians, the deadline is June 15th, 2021. If you don't file by the deadline, that may mean that you don't get your tax refund on time. And if you're owed a tax refund, which is the case for about 60% of Canadians out there, that means you're letting the Canadian government keep your money that's owed to you longer than necessary. Why would you want to do that? Missing the deadline can also mean delayed benefit payments. The government uses a tax return not only to assess your tax refund, but your eligibility for other tax credits like the GST or HST tax credit or the Canada Child Benefit. You will not receive these benefits until you file your tax return. And if you have taxes owing and you don't file by the deadline, you will have interest and penalties assessed by the CRA. The CRA will charge you daily interest on taxes you owe them the very next day of missing the deadline. You'll be subject to a 5% late filing penalty and an extra 1% for every month past the deadline. These fees can really snowball over time, and if you've been late in the past, that means these fees will double, meaning the late filing penalty is then 10%, and you'll owe 2% for every month you're late. Not only do you get charged interest on the taxes you owe, but the CRA will also charge you interest on the penalties you owe on top of that. So please make sure you file your taxes by the deadlines. Mistake number 6, not realizing some benefits are taxable. If you receive COVID-19 related benefits, that most likely help keep your finances afloat during these turbulent times. But the money you receive from the government for this program and others came with some strings attached. The benefits and support payments you received for COVID-19, you will have to declare them as income on your 2020 taxation year. These benefits are taxable. You either had very little tax deducted at source or zero tax deducted at source before these payments went out to you. So if you collected CERB or any other COVID-19 related benefits, you may have to pay some of that money back to the government when you file your taxes. That's why it's a smart idea to file your taxes early on, so that way you're not sticker shocked as you get closer to the tax deadline. Mistake number 7, ignoring mistakes you made on previous tax returns. Now that you know the most common errors and mistakes that Canadians make on their taxes, you can avoid them when it comes to filing your 2020 taxes. But what if you've realized that after watching this video, you've made some of these mistakes on your own taxes in the past? Maybe you missed a T-slip or missed a donation or a deduction. Like many Canadians, you might be wondering, can I correct my tax return that's already been filed? Thankfully, you don't have to worry about the fact that you may have missed out on tax savings in the past. Instead, you can and should correct your tax return as I'm about to explain. So what should you do once you realize you've made a mistake on your tax return after you filed? Personally speaking, there are things that I've missed out on my own tax return after I filed. So I've had to go back and fix those tax returns, so no need to worry. It's not a hard process. This can be in the form of forgetting about a T4 slip or a donation receipt that just came late in the mail. Or maybe you've claimed a tax deduction or a credit that you weren't eligible for. First, don't panic. People mess up all the time on their tax returns after they filed. It's not a big deal. And the CRA is used to people making mistakes and other errors on their tax return. The most important thing is that once you realize you've made a mistake, you own up to it and get it fixed. You are allowed to adjust your tax returns from the past 10 years. Any returns older than that cannot be changed. So let's say you just filed your tax return and you realized you've made a mistake. Wait until you receive your notice of assessment for that particular return. You can then file an adjustment either online through the CRA My Account portal or by mail using the form TD1-ADJ, which stands for TD1 adjustment. Either way, either method you choose, make sure you include all the line numbers and all the adjustments you want to make for that taxation year. If you want to make adjustments or corrections to multiple tax returns, you'll have to file a separate adjustment for each tax return. For paper adjustments, you can also include the necessary supporting documents like tax slips or receipts. It takes about 2 weeks or so to get a response from the CRA if you file your adjustment online. And if you file your adjustment by mail, it might take about 8 weeks or so. And if you're approved by the CRA for those changes, you will get a notice of reassessment notifying you of the changes that they've accepted. Otherwise, if you're not approved, you'll get a letter from the CRA explaining why those changes were not accepted. Now that you know the most common mistakes that Canadians make on their tax returns, you'll be on the lookout when you file your next tax return. One of the other ways to reduce tax filing mistakes is to use specialized tax software like Wealthsimple Tax. So as you're filling out the tax return, the software will point out mistakes and errors before you file. I've also created a step-by-step tutorial on how you can use Wealthsimple Tax to prepare your next tax return, so be sure to check that out. If you're using one of these softwares, you don't have to worry about bad math or missing out on deductions you're eligible for. You can also speak to an expert using the chat option in the software directly. With this video and using the right tax software, you're less likely to have an oops moment when it comes to filing your own taxes. I have links to promo codes and discounts on various services in the description of this video. They help directly support the channel, so please be sure to check them out. If you have questions for me, feedback on this video, or maybe you have ideas on future content, be sure to leave your thoughts in the comments below. That's it for this video. I'll catch you guys in the next one.